Bob Graham here, president of Riggs Asset Management Company. A couple of weeks ago, we had a discussion about what was going on in the markets and what a recovery could begin to look like. At that point in time, we thought we were in the early stages of a possible recovery in the market. And since then, we've seen that process, if you will, of recovery continue. So I want to talk about what we're looking at, what we're following to see if this continues, and also what we're doing in portfolios to take advantage of this environment. So first off, what have we seen? Obviously, with the tariff announcements that were far worse than most people thought, you had an ugly sell-off in the markets. Since then, we've been having this sort of a gradual, what I'll call 2 steps forward, 1 step back recovery. And what have we seen over the last several weeks as this has been happening? Well, we've seen improvements in things like the fear index. What's the fear index? We call it the VIX, and it's really a measure of volatility. In the early stages of this sell-off, we saw volatility spike to really high levels. 65 was the high in sort of a after hours period, but the highest close was 55. That's a really eventful move and measures the fact that the volatility had just gotten a little crazy. Since then, we've seen the volatility moderate, come down. So when we look at it in phases. I think about it, anything above 28 is extreme volatility. Between 28 and 18 is kind of moderate volatility. And anything below 18 is really sort of a normalized, what people think about, a generally upward sloping market. So right now, we've seen the VIX come down from the mid 50s, 60 area down to about 26, 27. So we're back in that more moderate, still volatile, but moderate volatility level. So what are we doing through this process? Well, you've probably noticed we've made some changes to the portfolios. In some cases, we're kind of following the individual holdings, whether they're individual stocks or bonds or ETFs. And we're saying, how is it doing relative to the market? What do the prospects look like 6 months or 6 months, 12 months down the road? And we're evaluating each one on its individual basis and how it compares to the rest of the market. And where we see things that we don't think are doing as well or for some reason may lag, we're swapping those out for things we think will do better. You've probably seen a little bit of that in your portfolio over the last, say 2 weeks. Right now, it looks like the markets are being re-led by technology, being re-led by, building out of artificial intelligence, the software companies in that space. We're getting a little bit of strength, not fully back to normal, but more strength in semiconductors. We're also seeing improvement on areas that are more leader-oriented and more aggressive-oriented, while other areas, let's say, like utilities are beginning to fade. Gold has done really, really well through this process. Maybe it's put in a short-term top right now, and we're seeing things like Bitcoin pick up. It may sound confusing, but bottom line is what we are looking at is we're seeing things that tend to lead the market in bull markets improving, and things that tend to lag the markets in bull markets beginning to flatten out. Again, I think this is going to be a process. We're working our way through it. Right now, it looks pretty good. Obviously, we remain vigilant, but there's been a lot of improvement in the market in literally a week and a half, 2 weeks. Hopefully that continues, but regardless, we're going to remain very watchful to any signs of change. Anyway, I hope this helps. Again, if you have any questions whatsoever, whether a personal financial question, what's going on with the market, please reach out to any of the Riggs team. We're here to help and guide you in any way we can. Thank you very much.